Welcome back. Today again I would be discussing on efficient market hypothesis and portfolio analysis. I'm going into the second lecture which talks about efficient market hypothesis. I've divided this into three parts. So we will be having EMH1 in the second lecture, EMH2 in the second lecture, and EMH3 in the third lecture. So I've divided it so that you can go in depth into understanding what efficient market hypothesis is and how it can be understood and used in your real life for investment purposes. So these are some of the topics which we would be discussing. First is the introduction to efficient market hypothesis. Then you have the background of efficient market hypothesis, the various assumptions, and what are the three types of markets which have been discussed over here, how it is going to affect the investors, and what are the drawbacks of efficient market hypothesis. There are certain repetitions which you can see in the previous lecture in comparison. So need not be worried about it, because it's just a continuation of what we have seen in lecture 1. So when we go into the efficient market hypothesis, what does efficient market hypothesis actually say? It says that the asset prices will reflect all information which is available in the market at a particular point of time. So if suppose there is information with regard to your financial statements, this is reflected in the thing. There are certain investor insider informations which is available. This is also reflected over there. Then there are certain decisions, management decisions, which has already been published. This is also reflected. So a market is considered to be efficient. Market is considered to be efficient only when all informations are depicted in the price of the share. Okay, so otherwise you cannot consider this to be an efficient market. This also has one catch. All informations available in the market, if suppose that can be reflected in the price, then the question comes that all share prices could be predetermined. You can calculate the price based on the information available in the market. No. In that case, it becomes an inefficient market. Okay. So there are many other factors also other than the informations published in available in the market, which is likely to have an influence on the prices of share. But these information is having a full reflection. Other than this, there could be certain other factors which is likely to have an influence on the market, and if it is not predictable, only then you consider the market to be an efficient market. Otherwise, it is an inefficient market. So what is the takeaway from this particular thing? It says that it is impossible for you to consistently achieve higher than average return without taking additional risk. So as I told you, additional risk talks about converting your inefficient market into efficient market, right? So the market is efficient, that is why there are additional risk which is associated with a particular market. As we have already discussed in the earlier lecture, that there are three types of markets: weak, semi-strong, and the strong forms of market. I'll take it up in detail in the coming market. So the market is considered to be efficient if suppose the prices of the stocks are consistently beating the availability of information. So which means it is difficult for you to predict the prices of stocks. The background of efficient market hypothesis, this was developed by Eugene Fama in 1960s. So it is just an extension of the work which was carried out by Louis Beckler in 1900. So you can consider him to be the father of the random walk theory, who said that the prices of stocks are behaving in a random manner and it doesn't have any impact based on past prices. So the extension of this particular study was carried out by Pharma. Later on, you find that many studies in this particular area have come up, even by Pharma or by other uh, researchers who have contributed immensely to this particular theory of market efficiency. Okay, so what does all these studies want to do or convey to the market? It says, talks about investment strategies and what theory, financial theory, has to be followed if suppose you are trying to invest in stocks or shares. The assumptions based on which efficient market hypothesis is working is divided into four broad categories. The first one says that the investors behave rationally. What do you mean by behaving rationally? It means to say that they are taking a decision based on the information available in the market. Okay, it could be all, whatever is published, non-published, anything of that sort. So the investors have a mindset to invest in those stocks which they feel is going to do good based on past informations. So that is a rational behavior of investor. The second assumption is that there is free flow of information in the market. So free flow of information in the market means whenever any decision is taken by the board of members or anything of that sort, automatically the information is reaching the stock market and it is reflected in the prices of shares. So uh, it should not be a controlled information flow, it should be a free flow of information. And if there is a free flow of information, then EMH is likely to work. So that is the second assumption. The third assumption is price adjustment. So as per efficient market hypothesis, they believe that whenever a stock um, price changes, there is some new information which has come to the market. So which means the prices are fluctuating based on information flow. Okay. So if the information flow, if the information received is good, then the prices may go up. If the information received is bad, then the prices will come down. So the prices will adjust according to the information flow. And what is the study based on all these assumptions for the investors? It says that you have to consider the market price to be true and there is enough opportunity to gain abnormal return if suppose the information is passed on, if the information is not passed on at the right time. Okay, so that is one important aspect you should understand, because the three rationals over here, most important is information availability and price adjustment, and these are likely to happen only if the market is efficient. Market can be efficient only when the flow of information is faster and it comes to the picture at the right point of time. So if that is the type of market you are working in, then you can gain abnormal returns. So as I told you, you have three forms of market which has been told by efficient market hypothesis. In the first lecture also I discussed about it using a triangle. Here the weak form of market, it says that the market is reflecting past information which includes the price of shares and the volume of stock which has been traded. So why these two are important, you should understand. How are these two related? I told you it is a demand and supply. It is based on demand and supply. Volume talks about how much is demanded. Okay, so volume talks about how much is demanded and how much is actually available in the market. So if suppose a company has issued 10,000 shares in the market, and out of this 10,000 shareholders, only 2,000 shareholders are actively participating in the market, then the demand would be dependent on this 2,000 shareholders. So if there is an increase in demand from 2000 to 2500, then what will happen? There is loss of supply of 500 and the prices is likely to go up, right? So this is the effect of price and volume. So understand it from that particular angle. So your past data will say what is the actual amount of floating shares which is available in the market. Based on that, the prices would be determined, and based on that, you should take a decision. Okay. Now, what are the implications of weak form of market? It talks about ineffectiveness in technical analysis, because all past informations are incorporated in the price. So technical analysis is all about the movement of prices using charts and other things, and this particular theory says that the information whatever is available in the market is reflected in the price in technical analysis. So if it is reflected, then there is no need for you to do a technical analysis at all. So that's the meaning of it. So nothing much to take care of it. It just says that it becomes ineffective because of the price movements based on the volume and prices of the shares. Okay. And random walk theory, it says the prices are randomly determined. There is no role to be played by any other factors. Okay. So that's another important. So here, what is the learning for the investor? The learning says that technical analysis or chart patterns are not going to give you any result of excess return. So don't be dependent on past informations. So that's the study. A semi-strong form of efficiency, as we already told, it includes the informations which is already there in the public domain, that is historical prices and volume. Along with those informations, you also have information like the financial statement, any news articles and any economic reports which the government or the company has published. All these informations are available, and these informations is reflected in the prices of stock. So this is going to have an impact on fundamental analysis, because in fundamental analysis you are going to study the financial statements and other things. So based on these informations which is available, it is reflected in the price but not predictable to the extent you believe it to be. Okay. Then if there is any rapid price adjustment, then it is likely to have happened because of some new information flowing into the market. So the speed with which these informations are coming to the market talks about the efficiency of the market. If the market is efficient, the flow of information would be faster. Okay. So the learning for investor is how you can outperform the market based on publicly available information. So how you can use the publicly available information and predict the prices and put your money into those stocks. The next is strong form of efficiency, which is the third category of efficient market hypothesis. In this, you have information, all public information, plus you have information which you can collect from individuals inside the organization. So this is also reflected in the price of stocks. So what does this actually say? It means to say that even the private information whichever is available in the market, even that cannot be considered as an important ingredient for determining price. Because the price is dependent on many other factors, and you can have abnormal returns which these stocks are likely to give. Okay. The next implication is it says that the market is perfectly efficient. If the market is perfectly efficient, then it means to say that all these informations are imbibed in the price of the shares already, and it cannot be a reflection of future prices. I cannot predict the price based on these information. So at the end of the day, what is the takeaway for investors based on efficient market hypothesis? It says both technical and fundamental analysis or insider information cannot always give you a better return according to your expectation. Okay. The prices are likely to fluctuate to a certain extent to the effect of involvement of these factors. So only then we consider the market to be efficient. So what is the implication of efficient market hypothesis on investors? I am not going to touch upon the first part of this because I have already discussed it in the earlier lecture. I will go to the next part, that is hold and buy strategy. Okay. So hold and buy strategy, it says that what is the best time for you to purchase a particular share and what is the best time for you to sell those shares. And in between these two, there could be a period of holding. Okay. So if it is an intraday trading, then the buying would be in the morning at around 10 a.m. The selling would be in around 3 p.m. and the holding period would be from 10 a.m. to 3 p.m. ये जो time है, that is considered to be the holding period. So in buy and hold strategy, it says that long-term holding strategy will always give you a better return, higher return. Okay. So when I was concluding the first lecture, I told you that it is always possible that you make a profit if all the other conditions are same and if there is no change in the functioning of a organization or management of that particular organization, then in the long run you can make a profit out of it. And by means of holding the shares for a longer period of time, you are not only gaining a higher return, you are also reducing the transaction cost. And this is something which you should understand, and this is the learning which you would be taking from this particular slide. So this again I have discussed in the earlier lecture, which talks about the criticisms of efficient market hypothesis, which talks about the emotional and cognitive biasness. So I believe that I should not invest in one particular company because they are involved in unethical practices. So it is good that you are not investing in it, but it means to say that you have certain emotional restriction towards a particular company. So if the market is considered to be efficient, you should remove your emotional and cognitive biasness and put your money based on the actual performance of the company. Only then the market can fluctuate and be considered as an efficient market. There could be bubbles happening. Bubbles is the extraordinary fluctuation in price either above or below the intrinsic value. I've already discussed what intrinsic value is in the earlier lectures, so you can understand. Momentum, if suppose it is moving up, if the index is moving up, the price also move up, or it can be inversely proportional. So accordingly, the momentum would be maintained. The higher the index goes, the lower a particular stock price comes down. So it's all dependent on how the economy is behaving towards a particular sector or industry. So real world behavior is often not actually reflected in the price of stocks. That's the criticism. And how this is relevant, you should understand that the whole of the hypothesis, as the name suggests, it's just an hypothesis or an assumption, this particular theory. It suggests that it is very difficult for any individual investors to actually predict how the price movements are likely to happen, even though we live in an informationally strong market where any information, be it inside or outside, reaches the public or reaches the press at the click of a second, because anything can be communicated through WhatsApp, through Telegram, or anything of that sort. So all information is transferred in the click of a second, and these informations reaches the stock market also in such short period of time. And if suppose the market is able to imbibe all these informations at the least period of time, then the prices of the stock is a reflection of these information getting passed on to the market. Okay, so efficient market is considered to be those market which imbibes all these informations which is happening within the company or within the economy or within an industry, which is reflected in the prices of stock, but consider the volume when you also consider the price. So that is the takeaway from the whole process. Thank you.